Hi, guys. Well, thank you for having me. Apologies for a bit of a small issue since the start. So, today I'm going to talk to you about, in a multi-asset world, how do traders, find the right product to trade? So first of all, what is a multi-asset world? Because we hear a lot of people talk about it. We hear, there's a lot of research being done. There's a lot of news. Analysts are talking about that. So really, multi-asset world is very simple. It's a world where investors have, multiple asset classes available to them, to invest in or trade, be it, stocks, fixed income, derivatives, cryptocurrencies, or, forex instruments. It has become quite a norm in the industry to offer some exposure to multi-asset classes. But it can get a bit technical because, these days we have, various instruments and various asset classes that, might be, so there's a difference between, the asset class and the type of the instrument within the asset. So for example, when we talk about futures, and we have instruments called, for example, CFDs and futures. So when deciding on your, trading or investment strategy, it's important to understand that. It's also important to have access to, to different array of instruments, unless you specialize in one particular instrument. So just some facts. What has happened in the past couple of years? So we, the global assets under management, projected to grow to 147 trillion, which is a massive number. The global stock market capitalization has reached $109 trillion in 2023, with 1,200 IPOs, making more companies available for investments. The rise of exchange-traded funds, so a popular asset class these days. So many, say, investors and traders are starting to, to get exposure to the various instruments through exchange-traded funds. It's a safe way to start. And while this is not necessarily accurately measured, but it's believed that over 60% of professional investors, institutional investors, employ some sort of multi-asset trading strategies. So the first kind of important consideration before you begin your trading journey is to really decide, are you an investor or you're a trader? And there's some kind of key differences there. So if we start with investing, more of a long-term view, months, years, you don't expect to, to generate return in the matter of days or weeks. Typically buy and hold, so you invest and, you let your asset appreciate over time. You research. You research and prioritize quality assets to invest in, so ETFs, government, like AAA government bonds, some of the physical assets like gold. And the primary strategy people employ these days are dollar cost average. So essentially, you just invest in the same thing over time, no matter what the market does. Typically it requires larger capital exposure because the returns are smaller over time, take longer time, so larger capital exposure. And people, as a rule of thumb, don't use borrowed funds, so no leverage, no margin. So primarily, fully paid investment, and ownership of the asset is important. So it's written into your name. Trading, on the other hand, a little bit different. So more speculative, short term, can be minutes, can be hours, can be days. Bi-directional, so you can buy, you can short, you can sell. So you have a number of strategies there. Speculative in nature. So short, medium-term trends, like the stock market is down, that's when a swing trader may come in and try to take advantage of that. Previous speaker talked about Bitcoin. Bitcoin last year, good buy, even better at the end of 2022. So these types of things, trying to take advantage of short-term trends. Vast array of strategies available, and too many to name, but technical analysis, fundamental analysis, various hedge fund related alpha generating strategies, all sorts of things. Typically, smaller capital exposure, but more risky, and people employ margin. So that's where the risk comes in. So borrowed funds, and the main thing is exposure to the asset, not necessarily the ownership, because you your goal is to make return from the price movement. So potentially higher return, but also also a lot more risky. So yeah, so a bit of kind of like wisdom. I don't know where you are in if you have exposure to the market, if you're investing, trading, or thinking about it. But strictly speaking, if you are just starting out and you're hearing all sorts of media reports, maybe some of your friends bragging about their returns and so on. Strictly speaking, the starting point should be low risk. That's where you want to be because you want to understand how it works. So majority of people should really be in the investing category. It's not necessarily the case. We know from various pieces of research that day traders or trading in general, leverage trading accounts for more than 50% of all volume in the market. But why that's the statistics is because we know that also majority of day traders unfortunately lose money. So so it's always better to start with something a little bit slower. So S&P 500, for example, you can see statistics here last 20 years, stable returns year on year between 9 and 12%. And if you think about the kind of like the interest rates these days, 5-6%, depending on the currency, right? That's basically double, triple over time, which is good. But of course, it's human nature to seek higher risks, higher returns. We all want to outsmart the market, each other. So people then go and start exploring shorter-term, riskier strategies. So long-term S&P, so actually if we look at previous century, 10% return pretty much throughout the entire century. So that's pretty impressive. Physical gold, so that's another asset. Obviously, when we talk about gold, we often talk about speculation via gold futures or CFDs and so on. But if you actually hold physical gold, pretty decent 10% return since 1971. But kind of like what I said, people are starting to get, they want speed, people want to see return faster. So if we compare US, for example, 1960s, the average holding time of a stock was 8 years. And, most recently, it has decreased to just a little over 5 months, which is, suggests that the trend is moving towards, more of kind of higher frequency, faster kind of like pace trading environment. And then, high frequency trading. So, over 50% of all US equity trades are actually in that category. And you can see retail trading is obviously on the rise as well since COVID, since 2020. Options in the US, other derivatives in Europe, Middle East, and so on. So, on the rise. But the kind of like the middle point there is unfortunately, 90% of traders lose money in the long run. So all right, so just a bit of a background. So obviously important, investing, trading, so, for you to decide, not to say that one is necessarily better than the other, as obviously, if you're starting out, let's say investing, but, people do tend to shift towards trading eventually. But so some of the kind of like strategy, some of it is like really common sense, and you might be thinking like, well, I kind of already know that, so I didn't come here for this, but in reality, this is a very, very simple advice, but that's what I employed in my own life, as a trader. So, apart from being where I am, I do trading on the side. So, there's a couple of like very basic questions which are very, very important because in reality, the investing trading is not difficult. It's just it's simple concepts that people fail to grasp. So, a couple of just simple questions. The first one is realistically, how much time do you actually have, right? Because if you don't have too much time, then that should impact what kind of strategy you will employ. I don't have time, for example, and for me, I can't do anything that's intraday or a couple of days. I need to choose higher time frames. What is your risk appetite? Another one, very, very important. You're putting $1,000 in your account. Are you ready to to part with that? Very quickly, can you deposit more? Can you, so what is your risk appetite? And in reality, a lot of people underestimate that because once your account goes into a drawdown, so essentially when you're sitting in unrealized losses, how much of that can you comfortably sustain without checking your mobile phone every 5 minutes? Cryptocurrencies is a great example of that. They're very volatile assets, but in reality, especially some of the smaller cap coins, you can find yourself 80% down. And can you for a long period of time, for years at times? So are you able to sustain that? So very, very important to ask. What is your risk appetite? How much capital you have? And then, of course, how quickly, with that in mind, do you want to see your gains? So It's kind of like doing a psychographic analysis of yourself, but in an honest way. Don't try to be a hero. Try to just be honest with yourself and answer these questions. Examine with that in mind. That's the first piece. The second one, examine already what you know. There might be a company that you follow. Those news. I don't know. Maybe you're reading about what Google is doing, or Nvidia is doing, or Bitcoin is doing. It doesn't matter. It's where your passion lies. Specific industry. Maybe a specific company you follow. Some of the trends. Maybe you're interested in energy or how things change, supply, demand. Because in reality, 50% of the work is going to be done, if you know that already. And then, align these two things, so how much time you have, your risk appetite, and your existing knowledge. And then, a couple of other points. So, investing or trading, we talked about, are you going to do it yourself, or you do a managed approach? A lot of brokers these days, offer, independent financial advisors, offer portfolio management, offer, some of the robo-advisors as well. So, you don't have to do it yourself. You don't have to, spend months, trying to understand. I mean, there's these things as well. There is, of course, a certain amount of reward that comes if you have done it yourself. But I think that's another question you have to answer yourself. You can start doing it through somebody else, and then eventually try to do it yourself. Okay, so having answered the kind of the questions around risk, around how to do it, then it's it comes in. So let's say I have interest in gold, I've been following the market and so on. So how do I get exposure to that? And generally, the two types of assets in general, how to do that. You can either invest in the underlying asset, or you can use a derivative asset. So some kind of key differences. If we're talking about underlying asset, then typically that means you're buying the underlying security, you're buying the company share, you're buying physical gold, you're buying crypto on the spot exchange. If we're talking about derivatives, we talk about things like CFDs, futures. So the asset is derived. The value of the asset is derived from the underlying asset. You don't own an asset as such. You have an exposure to an asset. And so some kind of key differences very, very quickly, because I'm going to be out of time. But in terms of the underlying assets, so of course the key benefit is you own the thing which you bought, be it a commodity, a stock, or a crypto. Long term, unleveraged, so risk is lower, but some limitations there. So maintenance costs, depending who you're holding it with. Crypto, you have to be really careful with cold wallets or self custody wallets. And also in some jurisdictions, it's very, very time consuming to actually transact. There's also limitations, like for example, if you don't live in the US, you cannot own a US ETF. CFDs, popular choice with a lot of brokers, scope markets included. So this gives you a bit of an exposure. So shorter term trading, you don't own an asset, but you get quick exposure. So again, market is down, very easy to open a position. You have leverage to employ and so on, but higher risk. Unleveraged CFDs also starting to come out, so kind of similar thing, but you don't have overnight financing charges, so a little bit cheaper to get involved. Replicates the underlying asset in its behavior, but you have to always think about the counterparty risk. Is my broker reliable? Licenses, stuff like that. And then futures, exchange traded, great way to, if you have larger transactions, so you transact on the exchange directly, but the position sizes typically are larger. Then there's a couple of hybrids like CFDs on futures, so replicates the underlying future behavior, but executed as with your broker as the CFD, but you kind of reap the same benefits. And then the options market, which is very popular in the US, less popular here. So essentially, capped risk, also leverage, and so on. So the final 10 seconds, but essentially on the broker, once you've decided that, so then, it's really examining, the size and history, what broker to go to. Look for the size and history, regulatory licenses, market access, and, key people as well, very important. Who is behind the firm, shareholding structure, owners, top executives. So that's it. Thank you very much, guys.